welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, please be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Marius Hutchison, an investment manager based out of our London office, and this week I'm pleased to be joined by Richard Carter, our head of fixed interest research, and one of our esteemed equity research analysts, Mamta Valecha. Hello and welcome to you both. Richard, we saw the US cut interest rates to 4% last week, with the ECB holding theirs at a much more palatable 2%. Was that to be expected? And were there any comments from the meetings of what's to come?
Marius, I mean, the ECB very much expected. I think the sort of policy in Europe's in a pretty good place, actually. Inflation's not too high and growth's kind of okay. So they're probably on hold for the foreseeable. The Fed was a bit more of a surprise, not the fact they cut interest rates, that was widely anticipated, but markets, I think, have been hoping that Powell would sound fairly dovish to go alongside the rate cut, and that wasn't the case, actually. He was very much at pains to point out that although the market expects another rate cut in December, that's far from being a done deal. So there was a little bit of disappointment around that. It's quite difficult for them at the moment, as we know, because of this US government shutdown. There's a real lack of economic data. So to some extent, they're flying blind. I mean, you've got sort of private survey indicators and whatnot, but things like non-farm payrolls and everything else, we're waiting to see. So quite difficult for the Fed, and I think they just wanted to downplay expectations that a rate cut in December is already a done deal.
Fair. So still some uncertainty. I don't think the markets have taken the US shutdown too badly, to be fair. Outside of interest rate cuts, it seems a day can't go by where we don't talk about Donald Trump and tariffs. Last week, we saw the US and China agree to a one-year trade detente, pausing a whole host of tariffs, or at least possible ones, including those on rare earth and chips. Was this already broadly expected by the market, or have we seen any movement since as a result?
I think it's been taken pretty well. I mean, it's hard to completely disaggregate because you've had sort of very strong earnings announcements as well going on, and there's still obviously the whole good feeling around AI and tech and all the rest of it. But I think the meeting and the sort of positive comments were warmly welcomed. There wasn't any sort of grand strategic agreement put in place, but I think you characterize it as a sort of temporary ceasefire for now. And it's good news that maybe the sort of worst case scenario for the global economy has been averted. The problem is, as we all know, you could scroll forward 2 weeks and Trump gets annoyed by something the Chinese have done, and it's back to square one. But certainly for the time being, the mood music's okay, and we've got Trump heading to China early next year as well, so that's something to look forward to. But as I say, the danger is that Trump changes his mind on China very quickly, but we'll see if that happens.
Yeah, very interesting. Aside from China, what do you think are the main focal points for investors to sort of keep their eye on related to Trump and his tariff policies?
Well, you've got things changing all the time, but the Supreme Court in the States this week, interestingly, there's a case or a few cases there saying that the Liberation Day tariffs were illegal, and they're going to start hearing oral evidence this week. Now, no decision is expected for a couple of months or so, but if they were to rule that the tariffs were illegal, that really would put the cat amongst the pigeons, not least because the US government's raised quite an awful lot of money from tariff revenue, which potentially might have to be returned. So that could be pretty dramatic if that happens. I do think the US government would find a way around any ruling and maybe use a different method to get the tariffs in place anyway. But we won't hear the decision probably for a couple of months, but that's something certainly to keep an eye on.
Yeah, that would be quite a turnaround. And the upheaval that you see in companies sort of trying to front load inventory and the like, if we went back to square one, disaster, I think, would be an understatement. Coming a little bit closer to home, with the budget fully in the clear sight ahead of us, UK government borrowing seems to have risen sharply again. Are we starting to see more concrete rumours as to what might be included at the end of the month in the budget?
Yeah, I mean, UK government borrowing is not great. They're still struggling to get spending particularly under control. Although that said, government bond yields in the UK have come down over the last few weeks quite significantly, and actually more than they've come down in other markets. So there are some sort of UK specific issues, really sort of better than expected, or lower than expected, I should say, sort of inflation and wages numbers. So that sort of increased expectations that the Bank of England might be cutting rates at some point. So that's good for the government. The bad news, of course, as we know, is that Rachel Reeves has a huge hole to fill in terms of the budget. There apparently been some pretty chunky downgrades by the OBR to their productivity forecasts. The way these things work means that Rachel Reeves will have potentially a sort of 30 to 40 billion gap to fill. And not surprisingly, there's been an enormous amount of the usual speculation about how she plans to do that. I don't think we can really sort of see anything as a done deal in a sense that these things change from week to week. What the papers and what the markets think is going to be the most likely sort of revenue raising measure, but certainly the budget at the end of November is going to be a very big event. The hope is, of course, that Rachel Reeves and the government will retain market confidence in whatever they decide to do. For now, with gilt yields falling, it looks like they are. But there's a lot of work to be done.
Yeah, I wouldn't want to be in their shoes. 30, 40 billion seems like a pretty big hole. As Richard alluded to, Mamta, at the beginning of the conversation, last week was a pretty big one for earnings results, especially for the Magnificent Seven, with 5 of the 7 reporting last week. Amazon's results seem to be one of the highlights, with their stock up around 12% the following day. What was your take on their announcements, Amazon in particular, and how has their guidance changed for the likes of AWS?
Yes. So Amazon certainly delivered last week with solid numbers across the board. But AWS, which is its cloud business, took the spotlight. So revenue accelerated to 20% as capacity constraints eased. AWS also regained the lead across the hyperscalers with the largest number of net new cloud dollars added in the quarter. Forward commentary on AWS was finally positive, with management noting that this is the fastest growth they are seeing in cloud since 2022, and capacity is getting filled as soon as they can get it online. Then we had Trainium2, which is a semiconductor chip purpose-built by AWS for AI training. These are set to be sold out to a few large customers. Management expects to be able to accommodate more customers, starting with Trainium3, and repeatedly called out like 40% power performance gains from the 2nd to 3rd generation, and citing cost as a strong reason for adoption. CapEx, which is another key metric investors look at, when it comes to big tech firms, this came in at $34 billion, with the vast majority attributed to data center infrastructure, so namely AI, but to a certain extent also to fund investments in the fulfillment and transportation network to drive down cost to serve. CapEx for the full year was raised to up to $125 billion and sits ahead of 2024, and no surprise is going even higher again in 2026. So these are of course very large numbers, but as long as it's funding profitable AWS related growth, investors seem to be quite happy. E-commerce, still an important part of the business, didn't get much attention last week, but revenues remain quite strong, up 11% in North America, where Amazon continues to expand its same-day delivery business. This is growing 2 times faster than the overall retail business, and Amazon continues to invest in both fresh grocery availability on same day and also expansion to rural markets. But Amazon highlighted more room to drive further efficiency, simple things like adding to an existing order, further reducing miles traveled. And just very quickly, subscription services was also up 11%. Prime remains one of Amazon's key differentiators with a very sticky, customer base and a high penetration of US households. And also, the Prime Video library is becoming increasingly more engaging. Finally, advertised revenue also very strong, up 24%.
Yeah, thank you. It's very interesting that you mentioned those other strings to its bow, because I must admit I get a little bit blinkered and just look at the CapEx number and the AWS side, but actually, obviously at its core, it's a e-commerce deliveries business, and that plus the subscription data is very powerful. Actually, that leads me on to my next question. The Magnificent Seven all too often get grouped together, but they are very distinct companies. From your perspective, how does Amazon compare, and how's it been faring versus its peers?
Yeah, certainly. Just to on the point of how it differentiates itself from other, the Mag 7. Of course, for Amazon, it's e-commerce business, which is integrated with its fulfillment and logistic network and forms the foundation of its, consumer-centric ecosystem. It is the biggest e-commerce retailer in the US. Amazon is responsible for $1 in every $3 spent on e-commerce. And as a result, many investors look at Amazon as a proxy for the health of the US consumer. Now, specifically to this year, shares have gotten caught up, as you can expect, on both AI, but also, tariff-related debates. But for now, focusing on AI and where Amazon stacks up against its competitors, it has up until now, been a laggard, judging by the slow AWS revenue growth rate compared to the likes of, Amazon's Azure and also Google Cloud. Both of them capitalized very early on high-profile AI partnerships and also in-house model developments. Additionally, Andy Jassy's narrative, on earnings calls around, AI hadn't been as compelling as the other two previously. And as I mentioned, AWS has simply been capacity constrained. But as I mentioned, last week, AWS finally delivered. But I think we sort of forget that the internet channel is still relatively immature. Cloud share of workloads is anywhere between 15 to 30% only. So there's a lot of revenue headroom to play for still. New entrants, of course, may come along. They unlock a better way to do things, such as TikTok with short form video, and also now, OpenAI with ChatGPT. These innovations, of course, all open up new end markets. But the incumbents, even if initially caught off guard, eventually they can't catch up. These tech firms have all the ingredients to succeed, from the scale to the infrastructure and also cash.
Yeah, I think you've actually hit the nail on the head there, because a lot of the noise we're seeing, not just from news, but also from clients, is around the potential of an AI bubble. And you've said that Amazon are very much using AI as a tool and seem to be seeing benefits. Are there other sides on the e-commerce side where they're benefiting from AI already? Not just looking forward to the next 5-10 years.
Yeah, I can, certainly feel that way when you're seeing big share price moves in response to AI-related announcements. Of course, high growth companies naturally have a high P multiple, at least when it comes to, the big 5 tech companies. And over here, I'm referring to the likes of Alphabet, Amazon, Apple, Meta, and Microsoft. They are nowhere near the multiples we saw during the dot-com bubble of around, 200 times price to earnings. And as we saw in the case of Meta last week, actually, the market is not giving total freedom to the AI hyperscalers to spend whatever they want in the race for AI market share gains, regardless of what happens to profits. Markets do care about earnings and cash flow. On how Amazon is using AI in its own international operation is actually a great question, and it is often overlooked that Amazon has been deploying AI to enhance its own, customers' experience across its retail business. There are multiple ways they are doing this, from using algorithms to analyze a consumer's browsing and purchase history to suggest relevant products. They are using AI to make the process of listing, a new product from a seller's point of view less tedious. This has historically been a very manual process, but now sellers can, for example, send in a few words, take a picture or point to a URL, and the AI tool will fill out, the product attributes with, very key word-rich listings. In its own fulfillment network, AI-powered tools handle, tasks like moving inventory, sorting packages, and optimizing space within the fulfillment center. Reduced time in processing order means increasing the number of items Amazon can get an offer on same day or next day, which obviously is great for the revenue line. And AI algorithms can also analyze traffic patterns, from delivery times and vehicle loads to creating more efficient delivery schedules, which of course reduces Amazon's cost per serve and also emissions. Of course, in many more ways, they are using AI into their own business, but these are just a few examples.
No, that's excellent. Well, thank you for those great insights, and Richard for the macro side. That's all we've got time for. And thanks for those of you who are listening. We'd love to hear from you. So please do review the show now wherever you're listening, and make sure you don't miss out on any future episodes by simply tapping the subscription button. We'll be back next week. In the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview, as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on markets news, industry insight, and our upcoming events and webinars on our website or our social media pages. Probably most pertinent is the day after the budget, on the 27th of November, we'll be doing a run through of the pertinent points for UK investors. So that might be the one that's most applicable to you. Finally, if you have any questions you'd like to ask one of our experts for our next podcast, simply ask them via the weekly comments page on our website. We'd love to hear from you. That's all we've got time for. So thanks to Richard and Mamta for your time today, and to all of you listening. See you next time.